Welcome to our second quarter investment update. I'm John LaBarca, Director of Investments here at Vision Capital. We appreciate you joining us. Earlier this year, we shared our mostly positive outlook for 2026, but given recent developments, it became appropriate to temper our expectations. Let's take a look back at the first quarter. We experienced softer markets for the first time in a while in Q1, driven by the war in the Middle East and surging energy prices. The S&P 500 fell 4% in its first down quarter in a year. International stocks continue to outperform the US in 2026, with the developed markets index falling only 1%. Small cap stocks had a better quarter, gaining almost 4%, despite a weak month of March. Inflation readings have been trending higher again in recent months. This began even before the start of the war. With energy and transportation costs now accelerating, the inflation outlook is higher. This situation has called into question additional interest rate cuts from the Fed that investors expected and removes one positive factor from our outlook at the start of the year. Global oil prices have surged more than 50% since the war began. 20% of the world's oil supply travels through the Strait of Hormuz, which is effectively closed. Aluminum, helium, fertilizer, and other commodities depend on this strait. This shock will likely lead to higher prices across many products and services. Europe and Asia are most dependent on the oil flow that has been disrupted. A prolonged conflict increases the risk of higher inflation and a global economic slowdown. However, the US economy has proven to be remarkably resilient in recent years. Since the pandemic, we've faced the largest rise in inflation and interest rates in decades, the implementation of significant tariffs, and a number of geopolitical conflicts. Each time, fears of a slowdown rose, but the economy grew through it all. While it could change, early signs show that both employment and spending are holding up. The most important question remains the duration of the conflict. If the closure of the strait is short-lived, and there's a lasting ceasefire coming, then the economic impact may be more limited. Private credit funds have also made news in recent months. The combination of poor underwriting practices and redemption requests has put pressure on illiquid private credit funds. Funds are now experiencing an increase in problem loans. Private credit loan volume has grown significantly in recent years due to investor demand. Estimates now put the category at about $1.5 trillion in assets in the US. We don't believe this is a large enough asset class to cause significant economic problems, but it's an area we are monitoring closely. More widespread losses could result in a pullback of credit extension. Despite the new headwinds, employment remains strong. We have yet to see any real-time signs of weakening employment in the US through early April. The number of new jobs being added to the economy slowed even before the war, but remains steady. Weekly filings for unemployment insurance fell throughout Q1, and filings through March reached the lowest levels in recent years. So let's turn to our outlook. While we entered 2026 with a positive outlook, we reduced risk in portfolios where tax implications allowed in Q1 of 2026 before or at the start of the conflict as the backdrop changed and we became less positive. Tax stimulus will still help consumer spending and the economy in 2026, but the surge in energy prices is now offsetting some of this benefit. Previously expected Fed rate cuts are now unlikely with the risk of higher inflation. The main risks for markets include a change in sentiment regarding AI, higher inflation as a result of a longer-lasting conflict, and the potential for stress to expand in loan markets. We recently also took some profits in our gold holdings after strong gains over the last year plus. We still maintain a healthy allocation to gold. And due to fiscal concerns, we continue to hold shorter duration bonds. Short-term interest rates are still attractive and involve less risk. Thank you for joining us again for our investment update, and we look forward to seeing you soon.